Hi, I'm Andrew Mitchell. Today we're going to talk about vacant land being held by an unpedigreed QEF. The facts are the same as in the prior two videos. Stan, a non-resident alien, owns 60% of FC, and Betty, a U.S. citizen, owns 40% of FC. In year one, Betty and Stan contribute $100 into FC. Also in year one, FC purchases foreign land for $100. Years 2 through 4, there's no activity in FC. In year 5, FC sells the land for $120, so it has a gain of $20. In year 6, FC liquidates, distributing the cash up to Betty and Stan. For years 1 through 4, Betty does not elect to treat FC as a qualified electing fund or QEF. In year 5, Betty elects to treat FC as a QEF. FC provides Betty the required QEF annual information statements for years 5 and 6. The land is considered a passive asset. FC is a PFIC with respect to Betty. As mentioned, Betty makes an election to treat FC as a QEF in year 5. Because the QEF election was not in the first year of Betty's holding period, FC is an unpedigreed QEF. So in year 5, FC sold the land for $120 and had a gain of $20. The gain to FC is long-term capital gain. Betty's share of the gain is $8. The $8 flows through to Betty and is taxable to her as long-term capital gain in year 5. Betty receives an $8 increase in basis in her shares of FC. In year 6, we have the liquidating distribution. Betty has no gain on the liquidation because her proceeds were $48 and her adjusted basis after adjusting it up by $8 was $48, so she has zero gain on the liquidation. So what would happen under alternate facts if FC had not sold the land in year 5 and Betty had sold the shares of FC at a gain of $8 at the beginning of year 6? So here's her gain calculation, sales proceeds of $48 and a gain of $8. The gain would be treated as an excess distribution. That is, the gain is not a long-term capital gain to Betty. So she's going to be subject to the excess distribution rules, taxed at the, she's going to have to spread the $8 gain over her holding period and calculate the tax at the highest ordinary income rate, plus an interest charge. So that's a bad answer for Betty under these alternate facts. So in the video 2 videos ago, we talked about no elections being made by Betty, and it was a bad answer for her in both circumstances under the base case and the alternate facts. She had an excess distribution, and that was not a good answer for her. Under the prior video, we talked about a QEF election in year 1 where we had a pedigreed QEF. And that was a good answer for Betty in both circumstances, both the base case and the alternate facts. Betty got long-term capital gain. In this video, we talked about making the QEF election in year 5. Betty has an unpedigreed QEF. In the base case, she gets long-term capital gain treatment. However, in the alternate facts scenario, she has an excess distribution in year 6, which is a bad answer for her. So if she has an unpedigreed QEF, she has a good answer if the FC sells the vacant land and then liquidates, but she has a bad answer if she just sells the shares of stock of FC. So to provide maximum flexibility, ideally you would want to have a pedigreed QEF and make the QEF election in year 1 of the holding period. And that's it for this video. I hope you enjoyed the video.